Everyone chases high growth like it's always a win. But the reality is changing. Costs are rising, investors are demanding proof instead of hype, and scaling isn't as forgiving as it used to be. So the real question now is simple. Is pushing for high growth still worth it? Or does it start hurting you once the numbers stop lining up? Capital used to be cheap. Not anymore. High interest rates mean every dollar you raise now costs you real money. Funding rounds take longer and investors are betting on vibes. They want evidence that your engine actually works. If your growth plan can't survive this new environment, forcing sales becomes risky fast. Investors have made their priorities very clear. They don't mind growth, but they won't bankroll messy growth anymore. They want lower burn, cleaner unit economics, and a path to profitability that isn't based on wishful thinking. If you can show that your growth engine runs efficiently, money flows. If you can't, the conversation ends fast. Investors have made their priorities very clear. They don't mind growth, but they won't bankroll messy growth anymore. They want lower burn, cleaner unit economics, and a path to profitability that isn't based on wishful thinking. If you can show that your growth engine runs efficiently, money flows. If you can't, the conversation ends fast. Startups don't get rewarded for chaos anymore. Discipline is the advantage now. Every dollar you spend needs intention behind it. Growth has to be profitable, not theatrical. And the only way to stay on track is by measuring the metrics that actually reflect reality, not the ones that make the deck look pretty. High growth only works when the fundamentals are actually supporting it. If your unit economics are solid and real customer demand is pulling you forward, that acceleration strengthens your position instead of stretching it. That's the kind of growth that compounds instead of cracks. When growth starts wobbling, the signals usually show up early. Rising CAC tells you acquisition is getting inefficient. Longer payback means your return on every dollar is slowing down. And if burn starts climbing faster than revenue, that's your biggest red flag. These signs don't fix themselves, they compound. Growth is actually worth chasing when the fundamentals are behaving. Low churn tells you customers want to stay. Strong retention means they're getting real value. And if your unit economics stays positive while you scale, you're not just growing, you're growing without breaking your cash flow. That's the kind of growth that compounds. When churn starts creeping up, that's usually the first red flag. Then you see payback stretching out, which tells you acquisition is getting harder to justify. If unit economics slip into the negative, growth stops being fuel and starts becoming a liability. And when burn rises faster than revenue, the worst thing you can do is keep scaling just because it feels forward. We're in a new growth reality now. Capital is expensive, so investors aren't rewarding burn anymore. They're rewarding discipline. You need proof before you scale, not vibes. And the companies winning right now are the ones running tight, efficient operations. Efficiency isn't the boring option, it's the advantage. There's a better way to grow, and it's not slower, it's stronger. When churn, proof, and cash flow line up, your position in the market actually gets harder to shake. Efficiency stops being a constraint and starts fueling ambition, because every step forward compounds instead of leaking out the bottom. That's when growth feels stable, scalable, and worth the effort.